Let's continue with DTAA questions and answers. Mr. Anil, age 49 years, a resident individual, furnishes the following of income earned by him in India and country N for the previous year 2021. India does not have DTAA agreement with country N. Obviously, section 91 question. It is quite easier question as compared to the last one. Income from profession carried on in Mumbai, taxable in India. Agriculture income from country N, taxable in India. Dividend income from company incorporated in country N, taxable in India. Royalty income from a literary book from country N, taxable in India, but 80 QQB effect will be there for 3 lakh rupees. Expenses incurred in royalty, that will be netted off. Business loss in country N, obviously we can set off with Indian business loss. The domestic tax law of country N does not permit set off of business loss against any other income, but India provides, so no problem. The rate of tax in country N is 18%. We will compute the Indian average rate of tax, take whichever is lower for computing relief. Compute the total income and tax payable by Mr. Anil in India for AY 21-22, assuming that he satisfies all the conditions for the purpose of 91 and does not offer any of this alternative tax regime, that is 115 BAC. Computation of total income, very simple, 8,50,000 less business loss of country N, 1,10,000, so net PGBP 7,40,000. Income from other sources, agriculture income 1,30,000, it is not exempted. Foreign agriculture income fully taxable. Dividend received from company incorporated in country N, fully taxable. Royalty income after deducting the expenses, net should be taxable, 5,50,000. Then deduction under chapter 6A, there is no direct deduction, but indirect deduction 80 QQB, 3 lakh rupees is provided. So total income is 12,05,000. One note you have to remember, whenever you claim any profit link deduction from 80 IA to 80 QQB or 80 RRB kind of thing, okay, then we have to check about AMT application. AMT is applicable in case of individual only when their net total income exceeds 20 lakh rupees. Here it does not exceed 20 lakh rupees, it is only a 15,05,000. Therefore, we should not apply the provisions of AMT. This is an additional note for your knowledge. Computation of tax liability of Mr. Anil. So, how do we compute tax? You know that any excess income 2,05,000 multiply by 30% plus 1,12,500. So, the tax amount comes to 1,74,000. Health and education says 4%. Tax liability 1,80,960. Rebate we have to compute by taking the average. So, 1,80,960 divide by our total income, which is 12,05,000. So our tax average rate of tax comes to 15.0174%. Okay, and average rate of tax in country N was 18%, whichever is lower, so we will select this one. And now we have to compute doubly tax income. Okay, look at the this computation is very important. Doubly tax income. Okay, agriculture income 1,30,000, tax in both the country. Royalty income total was 6,25,000, but 75,000 deduction we will provide, and 3 lakh rupees 80 QQB deduction, chapter 6A deduction we will provide. So net taxable income in both the country was 2,50,000. In India only common taxable income was only 2,50,000, not 6,25,000. Okay, dividend income fully taxable in both the country. Business set off we have provided, so we have to deduct it while computing the double taxation income. So double tax income is actually 3,55,000. So on 3,55,000 we will apply whichever is lower rate, and this 53,312 is actually a rebate, and then net tax payable is 1,27,648, but 648 will be rounded off to 650, and that is my final answer. Next question. Again, this question is little complicated in nature, so I advise you, please read the question, pause the video, solve it your own, and then check the answer. This is my humble request. This is the last question on DTAA we are solving. So I am requesting, I will read question for you. I'll go in my flow, but you please pause the video after the question is done. Try to solve it at your own, and then you cross check the answer. Mr. Ravi, individual resident in India, age 45 years, furnishes the following particulars of income on in India and country S and country T. Same question we have solved, country S and country T. So we have to compute 2 DTAA relief here, then we will add and then subtract from Indian income tax liability. Indian income. Income from business in Mumbai 4,40,000. Interest on saving bank account with ICICI Bank. Whenever you see saving bank account, one hidden section should come to your mind, and that is 80 TTA, 10,000 rupees deduction. Income earned in a foreign country S, rate of tax of country H is 16%. Agriculture income taxable in India. Royalty income from a book on art from a country S, gross 7,80,000. You know that 80 QQB benefit we have to provide. Expenses we will net it off. Income earned in country T, the rate of tax in country T is 20%. Dividend received from company incorporated in country T, taxable in India, IFOS. Rental income. Now, rental income is not taxable in India. We have to compute income from house property. Okay. So, gross is 3,30,000. Municipal tax paid in country T, which was not allowed in country T, but India will give the deduction, 10,000. So, this is IFHP, taxable in India. Compute the total income and tax payable by Mr. Ravi in India for AY 21-22, assuming that India does not enter into taxation avoidance agreement with country S as well as T. Therefore, we are talking about section 91 condition, and Mr. Ravi does not opt for 115 BAC, that is alternative tax regime. Now, section 91 when you follow, we have to write the conditions. Please understand, toward the end of the question, you have to write down the conditions of section 91. Assessor should be resident in India. He should have income accrued outside India. There should not be any, that income should not be deemed to be accrued in India. He should have paid taxes on foreign country, in foreign country on foreign income. So, all those conditions you have to write. Computation of total income for Mr. Ravi. Income from house property is the first, and that is the income that you have earned from country T. You have to ignore which country you have earned. You just have to compute. So, 3,30,000 minus municipal tax. Indian computation, very simple computation. NAV, from NAV 30% standard deduction. So, taxable value is only 2,24,000. Your gross income is 3,30,000, but taxable value is only 2,24,000. Why am I highlighting that? Whenever we will compute a doubly tax income, we have to consider 224 and not total amount. PGBP, income from Indian business 4,40,000. Royalty income, you can consider royalty income as business income or IFOS. Usually we consider as income from other sources. 7,30,000 after deducting the expenses, and then interest on saving bank account 42,000, agriculture income and dividend income. Total IFOS income you have considered here. So, this is the gross total income. From gross total income, right now we are having two deductions, 80 TTA deduction and 80 QQB deduction, 3 lakh rupees, 80 TTA 10,000. So, total income is 14,85,000. Now, again you have to check 14,85,000 plus 3 lakh rupees. It becomes 17,85,000. Therefore, AMT is not applicable. Alternative minimum tax is applicable only when you are, net taxable income. That is total income plus royalty deduction, profit link deduction exceeds 20 lakh rupees. Okay, then only it is taxable. Next, computation of tax liability, very simple. So, on 14,85,000 we have to compute 4,85,000 multiplied by 30%. That amount comes to 1,45,500 plus 1,12,500. So, 2,58,000 and 2,58,000 multiplied by 4% is equal to 10,320 plus equal to 2,62,320. Okay. This is the income tax India. Now, we have to compute rebate. Rebate we will compute in working note. And after putting the rebate, the net tax liability comes to 96,123. But because it is not rounded off, we have to round it off in a multiple of 10 rupees. So, 3 rupees ignore. The net tax liability is 96,120. So, let's compute the rebate for each country. Average rate of tax in India. Average rate of tax in India you will compute by considering tax payable. Please understand, this tax payable divided by total income. So, tax payable in India was 2,68,320 divided by total income. So, 18.069 is the average rate of tax in India. Average rate of tax in country S is 16%. So, whichever is lower is 16%. Now, we have to compute doubly tax income of country S. So, agriculture income 94, no doubt in that. Royalty income we have to consider like this, 7,80,000 minus 50 minus 3. So, net taxable income, doubly tax income was only 4,30,000. So, on 5,24,000 we have to apply 16%. So, rebate for country S is 83,840. Average rate of tax in country T is 20%. So Indian rate of tax we have to apply, which is 18.69%, which is very lower. Okay. Income from house property. See, we have taken the net amount, not the gross amount, 2,24,000. Dividend 265, total 489. On 489, we will apply whichever is lower rate, that is 18.069. So total rebate that we have computed under section 91 or relief under section 91 is 1,72,197. Notes, you know that we have to write down the condition of section 91. He is a resident in India. Income in a question arising to him outside India, okay, and is not deemed to be accrued or arise in India. Income in the question has been subjected to income tax in a foreign country, and assessee has actually paid the tax in the foreign country, and there is no agreement under section 90, that is DTAA agreement with those countries, then only section 91 benefit will be available. Thank you.